going back onto a gold standard, if you like, would limit the Indian government's ability to manage its own economy very substantially. And not only that, but I mean, they've spent all their time trashing their population for being gold friendly, because as far as they were concerned, these were imports which were completely unnecessary, and without it, India would have had export, net exports, whatever. I mean, basically they're anti-gold. They're now accumulating gold because they have to. The West's fiat currency system is on its last legs, and that's why these central banks are aggressively accumulating any gold that they can get their hands on.
The economies of Great Britain and its colonies were fully backed by gold as early as the 1800s, with the gold standard ultimately becoming the foundation of the international monetary system. Despite the rise of paper banknotes, governments committed to the gold standard by backing their currencies with physical gold reserves. However, in response to the Great Depression, President Franklin D. Roosevelt enacted the Gold Confiscation Act of 1933, requiring citizens to surrender their gold. This centralization of gold marked a significant shift, pushing the U.S. economy further from the gold standard. Alasdair Macleod highlights the growing interest in returning to the gold standard in recent years, particularly in response to the perceived failings of fiat currency systems. Central banks worldwide have been accumulating gold at unprecedented rates, signaling a shift towards recognizing gold's intrinsic value. Countries like Russia and China are increasingly basing their economies on gold, driven by economic sanctions and a desire for greater financial independence. Additionally, the BRICS nations are considering the creation of a gold-backed currency, underscoring a broader global trend of moving away from paper-backed monetary systems. Zimbabwe's introduction of the gold-backed ZiG currency has demonstrated the potential for countries to structure their economies independently of the US dollar, reinforcing the growing global movement toward de-dollarization. Research from the Federal Reserve Bank of Philadelphia indicates that gold-backed systems are more effective at maintaining long-term price stability and reducing inflation than fiat currencies. Although the future of the U.S. returning to the gold standard remains uncertain, the ongoing economic challenges posed by fiat currency, including rising debt, inflation, and dollar devaluation, contribute to a resurgence in demand for gold as a secure store of value. We will present clips from Alasdair Macleod's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
I think actually does lie in the Asian hegemons and the Shanghai Cooperation Organization and BRICS and so on and so forth. There is a whole world there which is actually larger than ours, certainly on a purchasing power parity basis and also in terms of population, which is going to thrive. I mean, you've got an industrial revolution which is happening throughout everybody associated with that, which is why so many countries want to be involved with it. But of course, at the same time, they're frightened of what we might do to them, like call in their debts or regime change or whatever how we traditionally manage these countries. So you can see that we're at a sort of bifurcation, if you like. The world is split very definitely into two, but it's going to be quieter on the BRICS side, I think, in 2025 than it has been in 2024. There's a lot of noise going on about, a new trade-backed currency, and Russia had something like 220 meetings for BRICS countries and also those intending to join BRICS all around Russia. I mean, this is very, very active. So I think that's going to dampen down a bit now. In terms of other geopolitical factors, I think that we are looking at trade, which is now going to trade tariffs are going to be the big problem, I think, in 2025, assuming that Trump means what he says, that trade is the most beautiful word. And assuming that Scott Bessent, his nominated Treasury Secretary, doesn't actually sort of stamp on that. I mean, this is actually another point. I mean, in the past, when you look at Smoot-Hawley, for example, Smoot-Hawley was passed by Congress, Senate, and then signed into law by President Hoover in early 1930. This time, what you have Trump basically shooting from the hip on tariffs. I mean, he's going to set the tone, I think, a lot more than the sort of, if you like, the elected politicians. So on that basis, we're going to see, I think, relations between China and America deteriorating. I think when it comes to Russia, there is not going to be an easy solution there, as Trump has told us. I think quite a lot of commentators sort of took the view that Russia would immediately change everything and bring in this, that, and the other thing, and we notice huge differences. I think the principal difference, and this is something which obviously, was practical, was instead of trying to integrate a whole new raft of BRICS members, they created an associate membership category, which allows potential members, if you like, people who have expressed an interest in becoming part of BRICS, to, if you like, go into a sort of waiting room while, the integration process for them develops. And this is something which isn't necessarily immediate. I mean, it could take several years. And the idea also that they were going to immediately do away with the dollar, no, that's going to be a long, long process. I mean, it's an evolutionary process, if you like. The idea that the Russians could sort of suddenly change this, I think, was actually stopped in 2023 when the Russian embassy in Nairobi floated the idea that, a gold-backed trade settlement currency would be on the agenda in Johannesburg. And it didn't make the cut. Why? China didn't want to, if you like, upset the world, upset the entire fiat currency system by backing this. India certainly didn't want to do it. India is Keynesian to the core. The idea of going back onto a gold standard, if you like, would limit the Indian government's ability to manage its own economy very substantially. And not only that, but I mean, they've spent all their time trashing population for being gold friendly, because as far as they were concerned, these were imports which were completely unnecessary. And without it, India would have had net exports, whatever, I mean, basically they're anti-gold. They're now accumulating gold because they have to. And I think also the other thing which is actually important in terms of BRICS is that the BRICS membership, of course, they talk to each other a lot, at government level and also at central bank level. And I think they're generally agreed that the West's fiat currency system is on its last legs. And that's why these central banks are aggressively accumulating any gold that they can get their hands on.
Alasdair Macleod discusses the current economic landscape by drawing comparisons with the 1930s, particularly highlighting the differences between the gold standard and the modern fiat system. In the 1930s, the dollar was still tied to gold at $20.67 per ounce, whereas today, the dollar is entirely fiat, leading to concerns over devaluation. Macleod predicts that the dollar will face a similar fate to what occurred in 1934, when the U.S. devalued its currency by 40%. He further points out the role of tariffs, specifically the Smoot-Hawley Tariff Act of 1930, which exacerbated the economic downturn. He warns that current protectionist measures, including potential tariffs against China and the European Union, will likely lead to similar trade disruptions and financial instability. Macleod's analysis emphasizes the severe consequences of the current global credit bubble, which he argues is the largest in recorded history. He notes that the Federal Reserve, in its attempts to prevent the bubble from bursting, has pushed interest rates down to artificially support the system, creating a cycle of one bubble feeding into the next. As the bubble inflates, Macleod foresees a dramatic collapse that could lead to severe currency devaluations. Macleod predicts that the role of commodities, especially gold, will become increasingly vital as traditional currencies falter. He notes that foreign holders of U.S. debt, such as China and Japan, are already selling off dollars and purchasing gold, reflecting a growing shift away from the dollar.
The big difference was that the dollar was on a gold standard, at $20.67 to the ounce. This time, we are completely fiat. So the devaluation, which occurred in 1934, when the dollar was devalued by 40%, is going to happen in the market. And I don't think it'll stop at 40%. But anyway, that's another topic. Other than that, there is a big similarity, and that is that in 1930, early 1930, Hoover signed the Smoot-Hawley Tariff Act into law. And there is no doubt, if you look at the trade history and all the rest of it in the 1930s, that was the big reason for the slump. Now, we also know that, money supply contracted by 40%, but that was banks and everything else going bust as a result of the mismanagement, first by Hoover and then by Roosevelt, of the economic situation. But the real catalyst in this, of course, was Smoot-Hawley. Now, today, in those days, it was principally to protect farmers and things like that. But what happens when you introduce tariffs like that, say against the European Union, against China? They hit back with their own tariffs or their own restrictions in terms of needed, exports. So, China has already put a ban list on some of her rare earth exports to America. That's even before Trump's got into office. You're going to see more of that. But the other thing, which is worse, is that in those days, you didn't have these long supply chains. Today you have. And introducing these tariffs basically kills off these supply chains. It's a process which has been continuing actually since COVID, when the whole global supply chain system just sort of came to a halt. That is a process which will continue, and that will drive America and the rest of the world into a slump. There are no two ways about it. And here we are sitting, sort of thinking the future is looking rosy. I read my newspapers and I see what the pundits are saying about the outlook for equities next year and all the rest of it. And they're all saying, they're all sort of saying that things like, well, tech stocks will probably, come off the boil sort of thing. But, the market's going to go higher over the course of the year. Probably not as much as we thought originally. This is nonsense, complete nonsense. This is a credit bubble. And I tell you what, just like a balloon, it's going pop. And that could be rather sudden. We're already beginning to see this, Kai. I saw a headline in the Wall Street Journal, I think it was yesterday, that there's been the longest run of falls in the Dow Jones index since 1984 or something. Yeah. 5 days in a row or 6 or 10, I got to, The FOMC statement yesterday, Powell, tried to sort of say, well, slow down on your ideas about cuts in interest rates in 2025. For goodness sake, I've been telling people that, bond yields are going to rise. Now, what the Fed does with that, is a separate question. But bond yields are going higher, and they're going to go a lot higher. And, we're beginning to see them break out on the upside again. Certainly, if you look at sterling rates, you've got a double whammy there, because you look at the chart of the long gilts, and they are soaring. The yield is soaring, which means that the price is collapsing. And sterling is also in a very, very sickly position. That is going down south. And I think it won't be terribly long before we see it back down to, well, there'll be a bit of consolidation at 120 to the dollar, then 110. Then I really think, unless this government changes hugely, and I don't see an IMF coming in as they did in the 1970s to tell the government what to do. I think at £1, $1, I could see that happening. And I could see it happening quite quickly too. It's amazing. Once a crisis starts, and particularly if that crisis is the popping of a credit bubble, and this is the largest credit bubble in recorded history, because every previous credit bubble, really from the 1980s, has been stopped from popping, basically by pushing the interest rates down hard to the point where the zombies heave a sigh of relief and continue being zombies. The result is that you get an accumulation, if you like, of one bubble into the next bubble, into the next bubble, into the next bubble, so that we're now in the largest credit bubble in history, in recorded history. And when this one collapses, it's going to take out the currencies as well. There is no alternative. When the tide breaks on this one, what does the Fed do? I mean, basically, it tries to rescue what it can because it's got a primary duty to rescue the government's finances, which incidentally is in a debt trap. It's got a primary responsibility to rescue the banking system, which will be suffering from all the bad debts in an economy as these zombies get wiped out by higher interest rates. And what are the banks doing? I mean, some of the banks are beginning to see this. So what do? They restrict their lending into the private sector. Or if they agree to lend something to the private sector in terms of providing it with liquidity, then it's going to be at a higher spread over whatever the Fed says, higher rates. So this is going to happen. I mean, there's no two ways about it. You've already got the two largest foreign holders of US treasuries turning sellers. I mean, China isn't buying anymore. She's easing her position out. She's actually selling dollars to buy gold. The Japanese institutions are in exactly the same position. They've got losses, if you like, on their dollar investments. They may have profits on the exchange rate, but they've got losses on the underlying investments. So they're not going to go and buy things out along the yield curve, that's for sure. I mean, if anything, they'll probably hold on to dollars, but this is a currency game suddenly. The dollar is the king rat of fiat currencies. It's the least dirty of the lot. And on that basis, when things start going wrong for the dollar, the other currencies are toast. I mean, and that's what the charts are now telling us of sterling very, very clearly. I mean, you call them bond vigilantes. It sort of implies that there are people deliberately acting in concert, determine the levels at which government funding take place. No, you've got a lot of scared people out there, and they're going to be a lot more scared, and they're not going to buy it. That is the problem. And I think that 5% yield on the 10-year US Treasury is first stop. After that, I see it going considerably higher. And I don't see how it can stop because of the debt trap. And not only that, but because of the trade policies. If they come about, and I'm pretty sure they will, not maybe quite the way in which Trump has said, that will collapse the US economy, the global economy. What then happens to government finances? The deficits just rocket. And the deficits are the primary source of collapsing the purchasing power of a currency. So that's what we've got, I'm afraid, in 2025. Part of the problem, I think, is that the Fed is using interest rates to try and manage economic outcomes. That is not the purpose of interest rates. The purpose of interest rates is to stabilize the exchange rate. So really, it needs to raise rates in order to stabilize the exchange rate. And I'm talking about the exchange rate, the dollar against gold. But of course, they think that gold is now part of the monetary system. Their propaganda basically is they've got rid of gold. So they're completely clueless as to what they're doing. But the consequence of the tighter interest rate outlook in America has been to undermine all the other currencies. So, the idea that the Fed actually has control over the situation, I think, is completely wrong.
Theoretically, nothing is stopping the U.S. from returning to the gold standard. As the world's leading economic power, America has the capacity, influence, and know-how to transition. However, it lacks the desire. Modern monetary theory, MMT, which assumes a limitless money supply, has dominated American fiscal policy for the past few decades, and nothing suggests its momentum will slow. Just the opposite. With the U.S. now holding a staggering $34 trillion in debt, far exceeding its annual GDP, the government is more inclined to continue relying on borrowing rather than addressing the underlying economic issues. While the U.S. holds the world's largest gold reserves, they are insufficient compared to the nation's debt. As global demand for gold surges, the U.S. dollar is gradually losing value and influence. In response, many nations are exploring ways to reduce their dependence on the dollar through de-dollarization. At the same time, the increasing global interest in gold highlights its enduring value as a stable and reliable asset. Share your thoughts on Alasdair's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.